Hello everyone, welcome to my channel Profitable Trading. Today I'm starting a new series in English, and the topic that I'll be discussing and teaching you guys is market structure. And the reason why you should know market structure is because it gives you two benefits. First one, it helps you to identify the actual trend, the correct trend which you need to know to be profitable and a successful trader. And the second benefit is you can position your stop losses accurately to a good possibility to avoid them getting hit. These are the two important things that you definitely need to know to be profitable and make consistent profits. So without any further delay, I will get into content soon. If you're looking into my videos for the first time, please do consider subscribing to my channel if you like the content, and hit the like, and don't forget to hit the bell icon, because as soon as I add the content, you'll get notified. And something special to call out, all the details and the explicit information that I'm providing is only available to people who sign up for mentorship programs in other channels. But in my channel, I'm giving out all the information that you get in the mentorship program absolutely for free. Let's get into the content, and you'll get to know that definitely that this is explicit content created for you absolutely free in a minute here. Right here. Let's get in. Okay, so let's get into the content to understand the really important part of why a market moves and where are we as retailers in the market. So, on this first slide, the important detail that you should know and that I'm about to disclose is the basic principle of market, the exchange system. How does it work? It reacts like a weight scale. That's very important, number one. And you'll know why in a minute here. And another important detail that you should know is market, the exchange system does not offer anyone upfront any profits. Meaning if you invest money in the exchange, it doesn't give you profit by default. So it works on the principle of zero sum, which means the side which has the advantage and plays well makes the money, and the other one loses. And the retailers are always on the losing side. Hence, you might have heard about retailers losing 99% of the times, 90% of the times, these numbers, right? Okay, having that in mind, let's see what really happens in the exchange system. So in this first example, I have a weight scale for you where you see retailers investing 0.7 on the buy side and institutions investing 5x. Now, between these two quantities, obviously the institutions quantity is pretty big. Okay, so in this example, market moves in the up direction, in the buy direction. Okay, because the weight is more on the buy side because of the big quantities purchased. And another key important detail that you should know now, since you know that institutions buy at a very big quantity, their orders don't get executed at the same time completely. Have that in mind. We'll get to know about that more when we get into the later part of the video. Okay, now let's look into the second example where you see retails investing 0.5. It's just an arbitrary example that I've picked for demonstration. Don't quote me on that. So 0.5x on the sell side from the retailers, and institutions investing 5x on the buy side. Okay, now among these two quantities, again, the institutions have the biggest quantity and they have purchased on the buy side. Okay, so now since the exchange system reacts as a weight scale, what will happen is the result of the market direction. In this example, the market will move in the up direction, in the buy direction, which is totally opposite of what retailers have invested on. So we are on retailers, as retailers, we are on the wrong side, because we really cannot create the amount of pressure needed for the market to move in the sell side, because the quantity purchased obviously from the retailer is always less. Okay, so that's a key important detail. Now, since you know this detail, which is really valuable and most of you do not know, you will actually find the reason and footprints of institutions to actually understand on which side is the institutions or the banks, because now you know that only being on the side of the institutions and the direction which they trade will make you profitable, which we will actually find out in the later part of the video. Now let's move into the next example, which is again another interesting content for you. Now in this whole buy cycle that you see price moving up and down, making a complete uptrend, I've indicated this blue colored icons as institutions, and these are retail purchases. Okay. Now consider institutions buying on this price level, price moving from 90 somewhere around 100 here. Okay. They're buying again a 5x quantity. And since they buy, market keeps moving up, right? As we saw in the previous slide. Now, when we see as retailers price moving up, what we do is we tend to buy. And as the price moves up, there's a lot of belief, right, in the market that price is moving up. So a lot of retailers join. You can see a big crowd joining here, buying, and price ultimately reaches the level of 150. Now, since they purchased this big quantity here at a discounted price, right? Quote me on this discounted price has gone to 150, right? This is just an arbitrary example, just the numbers, right? Just for demonstration. Now they start selling it back because they've made their profits. And since they know that you have stop losses, another key important detail that institutions and banks have a second level of access. They do not look at charts. They have the order charts where they can see how much liquidity on how much purchases have been made by retailers on what price. So this is the exclusive visibility that retailers do not have and institutions have. So this is the edge that the institutions have over the retailers. They know at which price how much has been invested by the retailers. Because they know this, it's really hard for us to always win and be on the profitable side. Okay, so this is a key important detail that you should know. Okay, now after knowing this, and since institutions know it, they move the price in the opposite direction, right, to cross all your stop losses and causing stop losses to hit on this place for the folks who purchased here, and then again a stop loss hit, right, and then price moves back here. And another reason why, see, there is always a why to why price is moving. Okay, when you try to get the answer for this why is when you become a successful trader, and this is how I have become a successful trader, by finding the reason why behind the price movement. Now when price is moving here in this direction, there is definitely a why, and the answer is, I did tell you a while ago that big institutions have big orders and they don't get executed at the same time, right? So they made a purchase at 5x, a big quantity, and that doesn't get triggered and completely executed. So they need to trigger the pending orders. To do that, they intentionally move the price in the opposite direction to reach where they have their pending orders. And at the same time, they're also causing the stop losses to hit, which means you're losing money and your money, hard-earned money, is coming back into the market in the exchange system, which they need because that is their profit. Remember, I told you that market doesn't give anybody any profit. Any amounts that you purchase does not give you a default profit coming from the exchange system. So whatever you have lost as retailers is their profit. Okay. Now, when they move the price back in this location, the magic that's happening is they're fulfilling a lot of things for themselves, like benefits. Now they have got the price here where they have their pending orders, which means after making this profit from 100 to 150, they're again buying at a discounted price. Okay, note this discounted price around somewhere around 100 or maybe 90, around, yeah, around 100. Okay, so again the price moves because that's a big purchase, obviously price moves. Okay, and when the price moves, some retailers participate in the buying here on this buy cycle, and they're quite lucky because in the previous buy cycle, right, a lot of retailers lost money. And in this cycle, institutions are not interested in hitting stop losses. They've already made their profits. They're kind of moving the market up. So this is where you can see that you are lucky. Sometimes you make profits and sometimes you do not. Okay, so now you might have known that why you make profits on some day and some day you're not able to make profits. You're not consistent. The reason is what we just heard on this video. Okay, so as a summary, right, on this particular day, which is quite interesting, institutions came with this 5x amount in the market. Now they left this market with an additional gain of 0.6x, which is all coming from your retail stop loss hits. Okay, so yeah, that's the important detail that you should know, and you know now, and you will be careful, and you now know the reason why you make money one day and lose another day. We'll get into charts to kind of see this actually happening in the market in a minute here. Okay, let's get started. Now we're looking at an uptrend, making higher high, price moving down, making a higher high, and making a pullback again. What we saw in the previous slides where we try to understand why price moves and hits some stop losses, right? So we have seen this concept. So the previous higher low, the pullback, the point from where the price moved up, is where the institutions hit us hard back and kind of makes a situation for retailers to quit their positions, uh, the stop losses, right? Where uh, you want to kind of quit those positions to avoid losses. And since we know that this is the intentional move from institutions, right, and you lose money if you trade around these zones, because you might have learned the retail concepts, which are support and resistance concepts, right? So this is a point from where the price moved up, making a higher high the last time. So a lot of buy orders and patterns would fall into this location. But since you know that institutions have the second level of access to the data and they'll hit these stop losses, they do that intentionally in the opposite direction, moving to the extreme positions in the opposite direction, and then price moves drastically with a great momentum back, making another higher high. Now, this is what I want you to do. Now, since you know that this is how institutions eat up stop losses and then move the price back into the up direction, I want you to spend time on charts to find this happening, this intentional stop loss eating movement, right? And start marking these zones and find out the spot of reversal from where price moves up in the up direction. This will be your high probable buy entry. You can quote me on this. This would be a very high probable entry where you will consistently make profits. Obviously, there are losses, but those would be reasonable and quite less, so you can make consistent profits. So in this whole buy trend that I have plotted for you, I've created the same high probable entry so you can see it for yourself multiple times and make a note of this. So you can feel free to take a screenshot, a screen grab, uh, take a print out, stick it somewhere, and kind of practice marking this reversal movement, which is high probable, because this is where we are seeing them eagerly needing liquidity from us, the retailers, and they move the price back. So this is where you should enter the trades. Okay, and as you know, after some time when market makes an uptrend and keeps moving in the up direction, there's a point when it makes into a good pullback, a correction phase, right, which I have marked in orange. So in this example, price moved and it broke the previous higher low. Okay, and we know something, it does break previous higher low is when the price moves up back, making a higher high. But something unique that happens in this example that is quite exclusive that I'm disclosing is price moves back up again to some extent and passes back again, breaking the higher low once again and stopping at the second higher low. Okay, so you saw this happening, breaking a higher low and moving up. And something new that's happening in this example is it has again moved beyond the higher low once again, and it has come back to the second higher low. Now this means, and this indicates to you that the institutions are selling big time, because as you know by now, right, after seeing the first part of the video, only big institutions can move the market in any direction. Now if, since they are investing on the sell side, the higher lows are getting broken, right, and price is moving drastically with high momentum in the sell direction. And something to note is it did not break this higher low. Okay, have this in mind. This is, on the left is your uptrend, and price drastically moving with a strong momentum in the sell direction, breaking one higher low. It did not move back in the up direction as it has to usually, right? So you might have this question, right? Because we learned that when it breaks the previous higher low, like this, when price moves back, breaks the previous higher low, it is supposed to move up and make a higher high. Why did that not happen here when price moved and broke the previous higher low? Why did price move to a very small extent and did not make an higher high, something like this, right? So let's try creating a price movement for you, right? Something like this, right? This is what we expect based on the methodology that we are following and kind of understanding here. So that is another tricky point, right, where retailers lose money, which is really important, and an edge which I'll be disclosing in my upcoming videos. What you have noticed is price moving up again and again after making a higher low, breaking the previous higher low for quite some time, right? And there's a reason why that price has got into a correction phase. So to know when to enter a buy trade with this high probable setup and to avoid a correction, there is an edge which I'll be explaining in another video, because everything has a detail that you need to know at an order. Okay, so in this video, let's stick to this point and try to understand that there is a correction phase that comes into place and where retailers lose money. And in the upcoming video, I'll explain how to avoid getting into this correction phase and stay into this buy trend always, right? Mostly with a good probability, and avoid this correction phase, because if you have entered a trade following this approach somewhere here, right after breaking the previous higher low, it moves to a limited direction, does not make a higher high here, and it falls back. So there's a risk management aspect that you can use, and there's another key important detail that will help you to avoid getting into the correction phase, which is, as I said, again exclusive mentorship content only available on my channel, where you can know how to avoid getting into a correction phase. So price came here, did not break this higher low. So this whole momentum, right, is where retailers lose big money. The reason is institutions want retailers to see that big selling is happening, okay, and they want retailers to invest on the sell direction. And when that happens somewhere around this position or this position, what they do is they wait for price to come here, which is their previous higher low, where they would have their big orders still pending, not triggered completely. The price moves up back into the buy direction. So you might be quite surprised many times when you have entered a sell trade that it was a really high momentum sell trade, or the sell trend that was going on. I entered into a sell position and the market moved and did not come back. What really happened? Was my pattern wrong? Was my support resistance zone wrong? Or was my trend line wrong? Whatever, right? All those retail techniques. you have no answer why it happened. Now, after watching this video, you have the answer. The answer is the main structure, right, is the uptrend, and when it's making a correction, you have to be really careful. That is definitely not a high probable sell situation. It is just a selling that has been triggered by the institutions, and it is to make the retailers invest on the sell direction so that they can take the market back in the opposite direction and eating up all the stop losses and taking your hard-earned money. Okay. Um, that is all on this video. We will get to know in the next video if you can sell. Yes, you can get into sell opportunities, but there is a risk management involved, which we will discuss, and we also will look into some additional price movements in the next video that will give you some further confluences to kind of get into a sell trade, but as I said, with some risk management definitely in place. Uh, Thank you for watching. If you're watching this video and you're the first time on getting onto my channel, consider hitting a like and a subscribe to my channel so you can continue to see this exclusive mentorship content coming to you. Hit the bell icon so that you'll get notified as soon as I add new content for you. Until then, goodbye, take care, and continue watching the whole series to become a profitable trader. Goodbye.